We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Larry Williams. He's been trading futures, commodities, and stocks for over 60 years now. Thanks for joining me today, Larry.
Oh, thanks for having me, especially to Calgary, one of my favorite places in the country and the world.
Well, we certainly have a contrast between our geographic locations, but thanks to the magic of technology, we can have this discussion today and have some charts for you to share your insights with us on your wealth of knowledge, looking and learning from the markets over the last 60 years here.
It really is incredible to see the changes. People talk about whatever's happening now, and maybe the world will fall apart. But we look back, when I lived in Kalispell, Montana, just shortly below you, we could never have done things like this, even between Calgary and Kalispell. And now I'm in the Virgin Islands and here in Calgary, and we just got rid of a hurricane and you're going to get snow. It's incredible. The good times have certainly unfolded, and there's probably more to come.
Yeah, it's a great perspective that we really need to take a step back from all of this negative stuff. And we were talking about running, for example, before we started recording here this morning. And I think it's important to be able to divorce this, as you said, some of this negative stuff that we're inundated by on the day to day, and be able to change our perspective sometimes, right?
Well, I think we all like negative news. I have my degree in journalism. I learned that you just write about bad things, write about houses that burn down, bank robbers and stuff. You don't write about the people who return money and good people. My son's a psychiatrist trained at Johns Hopkins, and he said, "Dad, everybody has a cognitive bearish bias. We all like to hear the other guy's doing a little worse than us." So we really feed on negative news, and you can feed too much on it. You can be too much of a pessimist or an optimist. Mm-hmm. And you get so into that conviction that reality gets in your way.
Well, and I think that more so speaks to, the human psyche in general. As a species, we obviously evolved to fear loss much more than we appreciate an equal gain. So when we hear negative things, maybe that's what drives us towards it.
Yeah, it makes us feel a little bit better. Somebody else is not doing real well. We thought, I'm not doing that bad. So I think there's part of that. But it's certainly, that was one of my problems. I think from 1962 until late in the 1970s, I had a distinct bearish bias. I made my first $1 million trading on the short side in the crash of 1970, and really cut my teeth in 1966. And so I just always wanted to sell short. I still do, but I have to be careful. But there's a time and a place for it.
Mm-hmm. Well, and that's part of what I want to dig into here today is really the time and the place for all of these different things. I'm interested in getting those insights from you, but maybe we should start by asking, what are some of your favorite indicators to watch? You've talked about your capitulation signal. So what does it mean for the broader markets if that signal hits high?
Well, if we see absolute capitulation in the market, which we saw in June of this year, we saw it right at the bottom in 2020, and we saw it in 2011. It doesn't happen often, but it just means basically the pain got so extreme for most investors, they just threw it up and walked away, got discouraged, as they did at the bottom in 2008. And that's usually historically, going back into the 1900s, has been a wonderful point to be a buyer. So I happen to think that since we saw the capitulation signal, we are in a bull market with the exact low. Usually the signal does get the exact low, not always, sometimes a little early, never been late. But clearly my bias has got to be on the long side because people capitulated.
So Larry, just to maybe make it explicit, let's get your take on the difference between trading versus investing. Is the only real distinction to you maybe the time period?
No, the distinction is one that's a lot easier than the other. Had I just bought the Dow Jones Industrial Average in 1962 when I started trading and held on now, if I bought $10,000 worth, it'd be worth about $3.1 million now, and I never would have worked. I've had millions of trades between then and now, and I made a little bit more than that, but it was a lot of work, sweat, blood, tears, agony, a lot of stuff. So, one is for a certain temperament, for people who enjoy trading or have some acumen at it. That's one thing. But for the average person, I would never recommend to do what I do. The average person should look at a place to invest money and maybe dabble a little bit. But, the upward drift of the stock market is just incredible. It's always been there. It always will be there. And you need to take advantage of that drift. It's the greatest money-making machine we've ever seen. It does about 9% a year. If you just hold through the good times, the bad times, it's amazing the wealth that it's made.
Mm-hmm. So maybe just to separate that into some of the positioning, let's say, in your experience, has the Fed become the most important factor to consider when trying to figure out how to position within the broader markets?
Yes and no. I think you have to go back to when the Fed began in 1913. And I don't think they really got a grasp on their congressional mandate, which is to maintain an orderly market and full employment. They really didn't figure out quite how to do that until around 1950. So the markets were pretty erratic up until that time period. I think from 1950 forward, on balance, you can always criticize them. They've done a good job, and we haven't had another 1929. Recessions have lasted, a year, and we're out of it. So the hard thing, though, they have so much good data at the Federal Reserve, is to find something that predicts market tops and bottoms. There are some that certainly seem to be leading indicators, but I have yet, this is the failure of my life, to find a one indicator approach, if you will, that always calls market tops. Still searching for it. And I just look in the Fed notes, look in the Fed indicator, look at technical analysis. I look every place. I haven't been able to find it yet. I can call market bottom pretty good, but tops, well, they're really tough.
Mm-hmm. Well, I don't know if a failure would be a great way to think of that, because, if everybody had a crystal ball that could call, let's say, tops and bottoms, then we'd all be millionaires, right?
Well, if that information was shared, but obviously if one would ever find a really good market top indicator, you'd keep it under your vest, you'd use it quietly. My bottom indicator, the nice thing about these indicators, the indicator doesn't cause the market to get bullish. It's a reflection of what's happened in the market. I really believe fundamentals drive market conditions, emotions drive market conditions. Mm-hmm. So if you can find those, I guess it's almost the old adage, in the land of the blind, the one-eyed man is king. So if you got a couple of good indicators, you're way ahead of the average person in the market.
Mm-hmm. So Larry, could you tell us a couple more indicators that you find very valuable when you're looking at charts day to day?
Well, I look at indicators a little differently than that, frankly. It's kind of like my running. If I went out this morning and ran half-mile repeats for speed, because even at my age I'm running, but I'm really slow compared to where I was. The next time I'll do for long distance, and the next time I'll do maybe sprints. So each workout has a specific purpose. I'm starting to high jump now, so that's a lot of plyometric exercise. I came close to setting the Montana record last year for my age group in the high jump, a whole different thing to learn, which is kind of cool to learn something new. Mm-hmm. But each indicator should have a separate purpose. So many people, I look at their charts and they go, I don't know, Jillian indicator, they're all the same. They're my William percent R, Bollinger percent B, MACD, stochastic channel. They're all the same. There's no difference between them. So what purpose are they serving? So to talk about purpose, for futures markets, I love to see the commitment to trader report. Mm-hmm. Because that shows what the large money is doing in the market, the big money, the small money. So that gives me a real great sense of sentiment in the market that I can't get any other way. This is real money, real dollars that are being traded and invested. So I would look for that, for let's call it smart money. Mm-hmm. Then I would look for seasonals, because usually markets do about the same thing at the same time of the year. Coming up in October this year, you want to buy IBM about the 19th trading day of October. That trade's worked, 85, 90% of the time, going back to the 1960s. Mm-hmm. So there are anomalies in the market like that you can find. So seasonals would be one, cycles would be one. I happen to think that cycles really matter. There are cycles to the way things happen. Accumulation, you can measure when smart money is coming in. Typically, people would use on balance volume. I developed an indicator in 1966 or 67 to measure accumulation. Still works really well. So each indicator has a specific purpose. And I have a culmination of those indicators. When they all come together, and then I probably have what could be a winning trade.
So obviously, you're just trying to stack the data to give yourself a balance of information to inform that trade one way or the other, right?
Absolutely. If we're going to play cards, it's my deck of cards and I deal. And there's a mirror behind you. And the cards are probably marked. I want to have as much going as I possibly can in a trade. So many people just saw one line crossed another line. It's just technical stuff. I'm not, there's a place for technicals, but it's a lot of mumbo jumbo there. It shows what happened. It doesn't necessarily mean that's going to continue to happen. A 7-day average can cross a 10-day average today and cross back tomorrow. You don't know. So, I like, as I understand the markets, and my understanding is probably limited, markets move from here to here for fundamental reasons, supply-demand reasons, economic condition reasons. But they go like that because of technicals. So you need both of them. But it really begins with the fundamentals. Fundamentals drive the marketplace. And if you could even be wrong technically, if you're on the fundamentally correct side, you probably have a better shot at it.
So obviously the closest example most investors can think of, Larry, was with the rise in interest rates that we've seen this year. We've seen, that be particularly bearish for stocks. But can rising interest rates also be positive for stocks? And how do we tell that difference?
We can tell the difference by a lot of study. Usually, you're correct, rising interest rates are bearish for stocks. But it's kind of like the snapping of a rubber band. It gets so far apart that it breaks. It's going to come back. So if interest rates are incredibly high, the Federal Reserve will take action, will bring rates down, and then it's going to have a concomitant effect on the market. I'll tell you a really fascinating one. It scares me right now, frankly, is if you look at when recessions have started, probably the best single indicator is when the Fed fund rates have been increased and increased and increased. That doesn't set off the recession. When they go down, when the interest rates actually, the Fed rate is decreased, that's when we start recession. Then it is mind-blowing to look at that chart. There's a Canadian, I'll get his name for you in a moment, who does a lot of work on recession forecasts. And it works really good. And I noticed that in his chart. So look at that. When it isn't the hike that seems to cause the recession, it's when they start to lower rates. Now that might be because they realize things are so bad, they got to do something. But that, if you want an indicator of when we're going to get a recession, that's been one of the best, the very best. It's so simple.
Yeah. Do you think that that's maybe, an artifact of that backwards looking data?
It could be. Again, it's I think the name is Forecast Advisor in Toronto or Montreal. It could be just the timing of it, the yin yang effect, if you will. But when you look at it, like right now, like, wow, that the Fed starts to lower the discount rate. In the past, that's been the start of a recession in the market, which doesn't mean stocks won't bottom the next day also, because stocks seem to be leading. Stocks have always, I think I'm correct in this statement, have always bottomed prior to recession ending. So there's a relationship, but it's not a real symbiotic relationship. It's not an easy one. Oh, once this happens, that happens. But clearly stocks almost always lead before a recession, and they also bottom before a recession is over.
But Larry, is it possible that framework has been completely changed with the reinvention of the meaning of recession?
Maybe. I think that raises a good question, because right now we're in a recession. We're not in a recession. If you look at unemployment, we're clearly not in a recession. I mean, we're at lowest level of unemployment. If I want to go in the business of printing help wanted signs, because everybody's trying to get somebody to go to work for them. So in terms of that idea, we're not in a recession at all. But if you look at other things, yeah, we're probably in a recession. So right now we have 1 foot over here, it's really positive. 1 foot over here, it's really negative. And so this is, whatever this is, I don't think this is something that we've seen any quite like this before.
Mhm. So where do you think we are in the inflation cycle? Have we seen the highs for inflation?
Oh, we've seen the highs. This inflation thing is over.
It's transitory,
My gosh.
right?
Well, it is transitory. There's a couple of things. When inflation gets real high, it's, like the rubber band, it's going to come down the other way. But more importantly, there are some leading indicators of inflation. One would be just the cycles. It's about a 5.5, 6 year cycle. Clearly, just look at your CPI charts. About every 5.5 years, we have a low 5.5 years later, 5.5, 6 years later, and the high is about the same thing. We are in the area of a CPI high based on just time cycle. So that's count one. Count two, it looks like the stock market's a pretty good indicator of in advance of what recessions are going to do. And maybe more importantly, if you look at the numbers of what's happened, we had, let's call it deflation during the pandemic. So the numbers were very low. So we're subtracting today's big numbers from very low numbers, which makes it look very inflationary. But we're going to subtract starting next month. The October numbers from October a year ago, we've lost a lot of that data that was negative, and you're going to see just on the mathematics of it alone, I think you're going to see continuation of the slope to the downside inflation, and that should be positive for the markets.
Mm-hmm. Yeah, just that comparative force, affecting the psychology of the markets, right?
Do the math. Look at the numbers you're dropping off. Yeah, you're dropping off numbers, and you've started to level off on the monthly numbers now. So I think that we're going to see some improvement there. That would be one. We got the stock market as leading indicator. And something I'd like to show, which is really fascinating to me, is if we look at the CPI index and do an algorithm, did we ever find this pattern before where the last 18 months, the CPI looks like it does right now? And if we can find that pattern, what happened in the future? Did inflation continue going up or did it continue going down? And so I think that there's a pattern to inflation that the CPI index that we've seen before, and that has some really positive influences, I think.
Mm-hmm. Do you want to show that chart, Larry?
Sure. Let's take a look at that right now. Okay, so what we're looking at here is really fascinating to me. The black line is the current CPI index right up to date. And the red line is what inflation was like in 1980. Remember, we had a lot of inflation back then. And look how this follows. But this is the interesting point. The inflation cycle that we saw in 1980 ended in this fashion, and it ended at just about the same time that we went from here to here. That's about what we've got in the black line being the current CPI. So this pattern from the past, from 1980, suggests to me that we should see a lowering of inflation, same algorithm we saw before. But hold on, there's a little bit more. People remember the most about Jimmy Carter was a horrible inflation we saw. Well, here it is, 1970, 74. And the red line was the CPI index back then, inflation, if you will. And today, the black line is exactly where we are. And again, look at how similar these two have tracked. In both instances, 1980 and 1974, and also if you look at 1990, you'll find the same pattern. The inflation lasted about this long, and then it came down. Well, here we are. The black line is how long we've been in inflation now. If it follows the path that we've seen in the past, it's going to the downside.
So you're just basing this on the cycle and time length of inflation in the past, right?
Exactly. It looks to me like there's a pattern that inflation has had in the past. Mm-hmm. And that pattern fits almost to a glove. If the glove fits, you got to quit. In 1990, 1974, and 1980. So I see the same pattern here. You use these algorithms for the stock market, a lot of things, but the pattern is so compelling. See it not just once or twice, but 3 times. Inflation seemed to last about so long before something happens, the Fed, the moon, I don't know what it is, but something clearly happened because the pattern is so similar.
Mm-hmm. So what aspects of this do you think could actually prove this theory wrong? We're seeing so much of the supply side constraint, and the Fed seems to be just trying to affect the demand side. So do you think that all of these issues with inflation, or that have caused the inflation that we have seen, have been solved?
No, I don't think they've all been solved. first of all, we're in a long-term inflation. We're always going to have inflation. And sometimes it goes really wild, like now and then it comes back down, but we're continually in an inflationary economy. You really need to keep that in mind. Has a lot of significance for longer-term investing. But as to right now, what's going to bring it down? Well, let's look at the commodity markets. What's happened to wheat, corn, soybean, crude oil? Those items have all come down. So that's going to start to come into the data. And I think that's going to be part of what causes the CPI to come down. Those are big numbers in the CPI. If you just take out the energy sector in the CPI, it looks totally different. So yeah, the declines that we've seen in plywood, lumber prices, housing prices started to come down. Now we're starting to see it roll over really throughout the economy, which is good and bad. It's bad in that it may be recessionary and bad for people that are holding those things. It's good for those who want to see less inflation.
So what do you think is the real driving force for inflation, Larry? Is it money printing?
No, clearly not. I used to think that. I used to say, oh, the Fed caused inflation. They print all this money. That was a really hard money advocate. I really believed that stuff. And year after year after year after year, I was wrong. Finally, it dawned on me that we're not in a gold-backed dollar system. We're in a fiat currency. And that was like a light switch going, boom, I've been on the wrong side of this, looking for bear market, the major decline, the world would end, whatever, because of this inflationary and the Fed. We're totally wrong. I mean, just look back at the history. You can't argue with it. So I think that once you consider we're in a fiat currency and you understand how that works, then your perspective and your belief about the future changes quite a bit. Because clearly, if we were in a gold-backed system right now, gold-backed dollar, it would be disaster. The only thing is we're not. We're not playing basketball here, we're playing football. So it's a different stadium, different rule, different equipment. And you need to bifurcate that view because we all like to hate the Fed, me in particular. But finally, I realized this is fiat currency. It was a huge awakening when I had that idea that no, this is not what all those books were written about. Mises, von Mises, and all these guys, and they're different reality than the one we're living in.
So where do you think that ceiling for that fiat currency ends up coming in? Where does debt start to matter? Where do our debt servicing costs start to matter? Or in some ways, is that just an infinite playing field?
Yeah, I can't believe I'm going to say this. My father would roll over in his grave if he heard me say this, but I don't think that it really matters. Well, it does to a point. You could get into the rental market we saw in Germany inflation or what's going on in Argentina right now today. So yes, it can get out of control, fiat currency. But if you have, hopefully, a Federal Reserve System that has some wisdom and is willing to do strong things, and they've shown that they are, you can regulate that by primarily increasing taxes. That's going to really put a stop on the economy, I think, even faster than doing interest rates. But they're going to try whatever they think works. So, I don't think that it's, in fact, we know this. One of the single best indicators of the future of the stock market is deficits. The bigger the deficits, the more we rally. And stop and think about that. It makes perfect sense because there's more money in circulation. People are buying stuff. People are building things. People are making things happen. There's money there. Once we have smaller deficits, it's not as positive. So the fiat currency, look at China. I went to China 1970, 75. It was a disaster. We only ate squash in one town because they had no transportation to get squash in the other town. And everybody wanted me to bring them back to America. They would live in my house and work for me for 7 years for nothing, just to get me out. Now I go to China and they have the fancy stores in the world there. Brooks Brothers there, Tiffany is there. Now I come and say, we'll build your house, come live with us. And totally, what happened? What's the one thing they did? Fiat currency. So clearly it can open up a huge economic, maybe Pandora's box in some people's view, but it can open up a huge expansion in the economy. It has to be done correctly, obviously. And it'll never be done exactly correctly. That's why we have these ups and downs. But I think on balance, to answer your original question, it's not the end of the world.
And do you think that the US has, really enjoyed this ability to print seemingly without inflation because it is the reserve currency of the world? And in the circles that you listen to, do you see that coming to an end anytime soon?
Well, I don't think it will come to an end. I mean, we've always had competition. We had it from Germany, then we had it from Japan 50 years ago, and now we have it from China, and now China's having a lot of problems. TikTok's been infiltrated or whatever. The great thing about the American entrepreneur is we are so mental. We think about things. We create things. We're very creative. The other Chinese like duplicate, Japan duplicate. They're getting more creative now than they were. But I think that's really the strength. And the people that I associate with, especially here in the Virgin Islands, my friend Warren Mosler, who's probably the leading modern monetary theorist. And I argued with him for so long and didn't get it. But I think that they're really onto something about this deficit and that the dollar can stay strong as long as we continue to be a productive country. As long as if we're not productive, if we slip into, say, Italy, and everybody sits around and says, hey, wait for that government check to come in, yeah, we're going to have a lot of problems. But if we continue to be productive, yeah, America, number one.
So what do you think is the best leading indicator instead for inflation?
Well, the stock market has done a really good job of leading the way for inflation. If you'd like, I can show you some examples of that. It was startling to me, by the way, because I'm a research-oriented guy, and I try everything else. Wow, could this be stocks lead inflation? I'm convinced they do. Let me show you. Okay, what we're looking at now, the black line is inflation. That's the CPI index. And the red line is the price of stocks going all the way back to 1998. And if you look closely, it looks like they're just following each other pretty much in sync. I mean, they both go up, they both come down at the same time. I'm going to talk about that in a moment, but just hold this picture in your mind. And here we go from that time period, 2001 and 3. Inflation goes up, CPI, the red line stocks go up, they come down. Look how closely they move together. Like, wow, they're really in sync with each other. And here we are from 2010. Again, look how much in sync we are. Inflation doesn't go crazy. Stocks in a nice uptrend, but not going crazy. We start to really inflate. Oh, look what happens. The panic of 2020, a lot of money comes in. Whoa, away goes the stock market again. It's like, wow. So you think maybe they move together. Well, no, because what I didn't show you is it's a blow up, so you can see it a little closer. Look how closely they parallel each other here, okay? Inflation goes up, stocks go up. But what I didn't show you is this. In all those charts you just saw, I had pushed forward stock prices by about a year, a little over a year. In other words, all those charts that you saw, like this one, had stock prices pushed forward. So we knew in advance what would happen with inflation. Let me make that clear. Here's a current inflation forecast. In other words, we know stocks pushed forward that inflation should follow. So when the market bottomed down here and inflation bottomed, we didn't bottom at the same time. We actually had this bottom known because the red line is pushed forward. Notice here's 2020, that's when stocks bottomed, right? But we knew inflation would bottom that much in advance. So it looks like, oh, look, at the end of 2023, start of 2023, we should start to see inflation, which come down, have a little bit of a bounce. Now it'll go lower. We don't know that yet, but the correlation, now is a causation, that's a good question. I'll let somebody else answer that. But the correlation is strong enough for me now that I say, well, gosh, I've looked at all these charts and stocks have led inflation. So kind of a really off the wall view. I've been criticized for this and probably fairly, but it looks to me like stocks lead inflation.
Interesting. So what happens historically to stocks when inflation starts to come back down, Larry?
Sometimes they rally and sometimes they decline. I wish we could say, oh, this will happen or that will happen, but sometimes they go up, sometimes they go down. You would think that they would immediately go up, and sometimes they do, but not always. So I haven't been able to find any really great correlations there. I've looked, but to find something I say, yeah, put your money down on, can't find it.
So, consequently, what does this mean for the bond market as well when inflation starts to come down?
Well, it should mean that we're going to see lower interest rates, and that's what should happen. Now, what will happen? I'm just a prognosticator, a guy trying to make some decisions about the market. But in theory, that's what should happen. I suspect that it will. But there are other ways you can confirm that. So we have cycles, we have correlations like this. But if you really want to know, especially with bonds and gold and stocks, all you have to do is go to the commitment to trader report, because that shows when the big money is coming in buying. If the big money is going to come in and buy or sell at a given time, and it coincides with what we've seen here, yeah, you probably got pretty much a locked on deal. So that's, again, I'm a conditional trader. Here's one condition that looks pretty interesting to me, but kind of confirm it with somebody really coming in, real money, plugging it down in the marketplace. That's what I want to see.
So, going through your work, Larry, I noticed a theme that you like to, or that maybe you have coined, and that's looking at fallen angels. So in that context, do you think that Bitcoin is dead?
Oh, Bitcoin was dead before it started. Again, I'll get a lot of comments on that, I'm certain, but I never thought there was much to Bitcoin other than a great speculative market, a wonderful, phenomenal trading market. But what did it really do? Could you eat it? Could you breed it? What could you do with it? Well, you could avoid paying taxes with it. You could sneak around the Federal Reserve. You think they're going to really let you do that? Duh, I don't think so. So to me, it was never a viable entity. But trading, oh yeah, there'll still be trading opportunities there, but it is a fallen angel. Long time before it comes back, if it ever does. I mean, I feel sorry for people that are in it because they really believe it. They bought the whole thing, hook, line, and sinker, and now they're stuck with it. There was so many of them. All of a sudden, everybody had a Bitcoin, right? It's really sad to see it happen, but that's the speculative bubble. That's the tulips of our time.
Mm-hmm. So another interesting correlation that I came across when going through your work is the dollar to crude oil correlation. So can the dollar give us an idea of where crude oil is heading?
Probably. I don't know how much causation is there or just a correlation I found, but that's something I worked with for quite a few years, and it varies. The time frame varies a little bit, probably because if interest rates are real high, the correlation or causation of interest rates and crude oil may vary. When inflation is real low or energy prices are real low and there's no interest rates are low, it's a whole different environment. So you have to look at the current environment to put all these pieces together. But I think it can be an indicator. The dollar index can be a pretty decent indicator of stocks that do a lot of international business, like IBM. Somebody that's buying a lot of stuff from China, like Walmart, like Costco. So it is an indicator that I think has value, these intermarket relationships. My friend John Murphy's written about it. Martin Pring's written about it. Tom McClellan's written about it. There's a lot there that we can still learn for sure.
Mm-hmm. So, when I was originally starting to speak with you about doing an interview, you mentioned to me that I wouldn't like your outlook for gold, and that really intrigued me. So, I try to get everyone's perspective on any point, whether it be gold related, energy related, or anything that we touch on. So maybe it's a good place to start to lay out for us what you think drives the gold market.
Well, clearly what drives the gold market is a commodity. People use it. They make computers with it, make jewelry with it. It's a commercial commodity. It's driven the same way that wheat and corn and soybeans. The only difference is some emotional exuberance because of the talk show radios, the hard money advocates who believe that it's the savior. So that's an emotional supercharge that comes into the gold market. So it's a commercial market. It's clearly driven by buyers and sellers, producers and users of it. But then you have that emotional kick on top of it. And I think that's really the driving force of the gold market. Mm-hmm. It certainly isn't driven by inflation. It certainly isn't driven by stock market declines. We had a huge stock market decline this year. What did gold do? It went down. What did gold do in 1929? It went down. What did it do in 1987? It went down. What did gold do in 2020? It went down. What did gold do in 2008? It went down. So this is one of the biggest wives' tales of them all. Oh, in an inflation or in a depression, when the stock markets get crashed, gold will go up. No, there's no historical evidence of that. None. It's all emotional. It's all in people's heads. But if you look at history, it's real clear gold doesn't go up when we have major stock market declines. So what does? Alcohol stocks like Diageo, a couple of others, that goes up. And when people are depressed, guess what? They drink more booze. They don't go buy gold. It's a depression. Everybody's depressed. Gold, it's a really great misconception people have. And I love to share that with people so they wake up and go, whoa. So if I want to buy gold, more power to you, but do it for the right reason and at the right time.
So what would be the right reason and or the right time to own gold?
Well, I'll answer that indirectly, and then I'll directly answer. Clearly, you would think that what I always thought before, and I was wrong on this, I've been wrong on so many things, but here's what I was really wrong on. Inflation drove the price of gold. That's what I thought. Mm-hmm. But we had huge inflation this year and gold went down. So I got, well, cross that one out. That didn't work too well, did it? And I go back and look at other times when we see the CPI index go way up and gold doesn't go way up. So that's not the be all end all of why gold prices go up. So that's been a misnomer. If I look at money supply, you think when money supply goes way up, gold will go up. No, there doesn't be any correlation there at all, or consistent correlation. So to answer your question, if I'm correct in my view that gold is a commercially driven market, when the commercials, the users and producers of the commodity get bullish on gold, when they're net long gold, and the evidence is hard on this, gold, it will rally a significant amount. So if you want to be really long gold, like I said, do it for the right reason and do it at a time the commercials themselves are net long. And we're getting close to that. Silver, the commercials are net long in silver now. That's really bullish for silver. It's not a timing tool. But it's a zone where, the commercials are starting to buy here. I can show charts of that. We haven't seen this very much, but when we do, this is a really bullish scenario.
Mm-hmm. Yeah, I'd love to see a chart of, let's say, the commitment of traders and how they've started to position in that way.
Great, let's take a look. What we're looking at here is a weekly chart of gold. I've taken it back to 2003. The red line, that's when I really pay the most attention to, is the net position of the commercials. The commercials are the producers and users. They're the miners of the produced gold, and then they would be the users, the computer companies, jewelry companies, et cetera. And the line simply, when it's going down, means they've been selling. When it goes up, it means they've been buying. So notice like they were heavy buyers in 2009. In fact, that was the largest long position they'd had since back in 2005, right at a market low. In virtually every one of these lows in the gold market, you'll see this red line, the commercial buying comes up as they start to buy, and then gold takes off. Now, the opposite side of that, the green line are the small speculators. They're almost always wrong. You can see how they have the smallest long position right back here. That was the least bullish they had been, well, going back all the way before 2003, and that was a market bottom. I feel sorry for these people. Look how bullish they were. This is the most bullish it had been for the last 4 or 5 years, right at the market high. So the players in the game, that I was talking about earlier, really matter. Let's just bring this up to date. I want to show you what is even more significant in my opinion. And that's
looks almost exactly like an inverse chart.
It's close to inverse. They tend to be inverse, not always though, and it depends from one market to another. But when the commercials get net long, as they did here, that's the first time they've been net long for a long, long time. And look what happens to the price of gold, up it goes. So like I said earlier, as I've written this in my books 20 years ago, 30 years ago, when the commercials get net long, you better get long gold. Mm-hmm. That's going to mean more to me than Joe Biden, who, I wouldn't vote for Joe Biden. I don't think he's an economically brilliant president, as well as a few other things. But does that affect the gold market? Well, what affects the gold market is when they get net long. Look at that. In 2018, they got net long. Look what happened to the price of gold. Then that red line over here gets above the horizontal line. They are net long the market. And because they're hedgers, you have to keep that in mind. They seldom get net long because they hedge. As the market rallies, they're going to sell that rally because they produce gold at, say, $1,000 an ounce, and if it goes to 2,000, they'll sell some gold. And if it goes to 3,000, they'll sell more gold. So they're hedgers. You have to consider that. Big news though. Where are we now? Look, right here, right now. Ooh, they are about the largest long position since 2019. they're getting close to being net long. I don't know if they're going to get there or not, but if they do, yeah. And again, if we look at the green line, the small speculators, they were really bullish right at the top. And these guys were really bearish. So the driving force of gold market, this is like wheat or soybeans or cattle or silver. And let's look at silver as long as we're talking about silver, because that has started to get a very positive commercial position. They are net long. There's a zero line right there. And they have just got net long. And that doesn't happen very often either. Let me put a line on that so we can see that a little bit closer. Do this one. There. So when they're net longs, they work back here, nice rally, right here, nice rally. They start to buy, silver rallies. So the fact we've seen them net long right now, I think is significant. This is the time, if I was going to be a gold bug, this time I want to be a gold bug. This is the time I'd listen to Sean Hannity and all the talk show guys. But this market, clearly, we should have seen a huge rally based on inflation this year. We didn't. And it really, people just have this so wrong as to what should happen in these markets. It's upside down thinking. It sounds like, yes, if we have a depression or a recession, gold should go up. But as I said, there's no historical evidence of that. It's on the contrary. If it does, it doesn't go up very long. So that's why I think, especially in today's environment, gold is a commercially driven market. It's just like potato chips. There's buyers and sellers. And you figure out when there's an abundance of professional buyers, it's probably going to go up.
So again, just to, I guess, reiterate the importance of this commitment of traders report to you and their positioning is what would signal a time to, start at least paying attention to that market, right?
Well, I'm paying attention to it now, clearly. I'm looking for an entry. So what would an entry be? An entry would be some trend change. Maybe in your case, the moving average, a trend line, a volatility breakout. I've got my own timing tools, but whatever timing tool you use, you would want to put on top of that. We have a bullish condition. I mean, be looking for a change. It says, oh, the trend is now to the upside. Here's silver in 2008. That was a big bear market, remember? It was a huge bear market. Well, look what happened to silver. Down. It shouldn't have happened. But again, that's my point, is that people have it all wrong. When we have depressions and recessions and stock market bear markets, these precious metals don't rally. I mean, that's shocking to see that, because everybody thinks it's just the opposite. It should have gone up. It didn't, nor did gold.
Excellent, Larry. Well, it's interesting to look at this stuff from your perspective and see a different take on the important factors that really move this market, right?
Well, yeah, and this is trading, this is investing. So I don't have the monopoly in truth here. I have my ideas of how I think the market works. There's other ideas. I respect those ideas. I understand them, and this is the truth as I found it in the marketplace. Other people have their own truth, and we trade our truth. So what I hope I've been able to do is share some of the truths of the things I've found from my research in the market. To me, I'm a numbers guy. I'm a research guy.
Yeah, and like you say, that this wouldn't necessarily give you a particular place to buy, but it would start to add to that weight of evidence. And then once you got a crossing of that trend line or volume breakout, that's when you would look at more seriously taking a position.
Exactly. So I think it's conditions are there that should cause a move, but they're not timing conditions. And so timing comes when a market enters a new trend. You can measure that with a 50-day moving average or a trend line or however you want to. There's a lot of ways to do that. Everybody's got an entry technique. But if you get an entry technique on top of this condition, then your entry technique should be a lot better than just any random entry technique, because there's no condition there. I'm a conditional trader.
One of the other themes that I notice in your work is seasonality to many of these markets. So why can this play such a role in some of the markets that you're looking at, Larry? Maybe we can use the Dow as an example, or I believe you mentioned IBM earlier too, right?
Yeah. Seasonalities are probably more apparent in agricultural commodities, because we kill cattle at a certain time of the year. They're born at a certain time of the year, year after year after year. We harvest and plant wheat at specific times, so that crop is produced. So a lot comes on the market in the fall. So there are seasonal patterns to these markets. And there are some in the stock market, the bond market. I think most all markets have some type of seasonal influence. We see one strong coming up now in the stock market. That's typically we've rallied from October into the end of the year. Not always so. Not a lot of times we haven't. And it's really interesting. If you go back and look at stocks from say 1900 to 1950, the phrase people use now is sell in May and walk away. Back then, if you would have coined something, it would have been buy in May and make some hay, because that was the best time to buy stocks. Mm-hmm. So these seasonal shift, you have to pay attention to them. And I do. They're suggestive. They're not mandatory, just because prices usually go up in October. Doesn't mean they'll go up every year in October. But usually, yeah, they will go up in October. So it's another element that we can put in the equation, if you will. There are a lot of strong ones coming up in the stock market right now. Let's take a look. Before we get into seasonals, let me quickly show you an intraday cycle forecast. This is the red line, and notice it goes out in the future. So it's predictive. And that's what I think makes a difference in my work and so many people's work. I live in the future. I have to have an idea what's going to happen tomorrow, 3 weeks from now, next year. That's what this red line does. It says we should start to rally, start to come down, start to dip again, and start to rally up. But then we're going to dip again in a day or so from here. So I like cycles to give us an idea of what may happen in the future. Now, if we look at individual stocks, let's see if we can find IBM. Here is IBM. The blue line is my true seasonal, which is a lot different than anybody else's seasonal pattern. I wrote the first book on seasonals and commodities way back in 1973. I made a huge error in the book. I assumed that today's seasonal pattern is the same it was going back in time, and everybody kept the same thing. So whatever the pattern looks like today, though we're using data from, say, the last 5 years, we're using that to show what it looked like 20 years ago. We didn't have that data. We're using out of sample data. So this is strictly in sample data. This is right up to the current time period. But you can see typically, this is the October low we've seen in IBM. Most every year, look at that. We've seen a rally point in IBM in October. Is it specific to the day? No, but it's pretty darn close. And we're coming into one right now. Let's expand that a little bit. And this is on a weekly chart. So you can see about the second week of October, right, what happens? We usually rally in IBM. So that's an example of if I'm interested in a stock, whatever it is, I say, well, okay, what usually happens in this stock? No guarantee it'll happen this year, but how usually does this stock trade? Now I know. Again, as I said earlier, in the land of the blind, the one-eyed man. Let's take a look at, I'll go to a daily basis. So here we are in the S&Ps, the black line, of course, the S&P mini contract, and we get a pretty good idea. Usually at the bottom this time of the year, it's usually rallied. And usually it's a dip from just about now down into the 1st of October. And then we can start to see the market move back to the upside. If I had to be specific, usually about the 15th to 19th trading day of October, the market put in a low. Mm-hmm. So these can actually be pretty specific, or at least like really narrow my time frame. And like right now, we should start to see this decline in the marketplace. Will we? I don't know. Mm-hmm. But if I'm short, I have protective stops and I'm a trader. That's all there is to it. But it gives a general idea when we should see tops and bottoms and rallies in the marketplace.
So is that blue line just the average numbers over many years laid out on top of each other?
It is the average number, the blue line, of how prices have traded on average for the last, what do we have, 25 years of data here. On average, this is how it's traded. So usually we see a rally here, a bottom here. Usually we see a decline over here. That's usually what happened. Mm-hmm. So you can then compare today versus what usually happens to see if there's weaker or stronger, what's going on right here, right now.
Mm-hmm. Interesting. Yeah. And again, just adding to your weight of evidence, right?
Exactly. When I was a kid, there was an ad on the radio. I'll never forget it. It meant so much to me. It was for Anacin. And it said, Anacin is like a doctor's prescription, a combination of ingredients. And I remember having a headache, and I asked my mother for something. She said, well, have an aspirin. I said, no, I want an Anacin because I want a combination of ingredients. And that stuck with me to this day. Like, yeah, if you're going to be a trader or investor, you probably want a combination of ingredients, not just one be-all, end-all thing. I don't think there is. Mm-hmm. I got an email the other day. Somebody said, tell me the secret of the market. Well, there isn't. Hard work. It's risk. There's no any one secret to this stuff. It is what it is. So it's a bunch of these things when they come together. That's what excites me.
So Larry, right in that vein, what is your best advice for traders? Is it hard work? Is there a particular place that you think that people could start that would give you the best bang for the buck in terms of learning skills to start to get a grasp on the markets?
Well, I'd say, first of all, don't do it unless you have the time and the passion for it. Tony Robbins says, be passionate about things. I think that's a false flag. I was really passionate. I wanted to be a professional football player, but I didn't have the skills or the size to do it. So my passion got me in trouble. You have to find something that you're passionate about, but also good at. And then you can start to create a career. That would be step one. Number two, obviously, you're going to look for somebody to help you. And I'm probably not the guy. I don't know who it is, but it's probably not me. But I can tell you who it should be for you. You should find somebody who almost instantly go, I see it. My dear friend Tom DeMark is into Fibonacci. He uses it very effectively. I don't get it, but my mind just doesn't work that way. So you need to find somebody who you say, I get all this. Then he can teach you better because you're naturally in sync with him. And then regardless of who you work with, what you do, you've got to learn money management. You've got to learn to control. Money management is really, it's not what people think it is. It's really emotional management. People go crazy, commit suicide. I've had 5 or 6 friends commit suicide because they were losing too much money. Had they lost a tenth of that money, they wouldn't have killed themselves. So if you don't manage your money well, you will get over emotions. Your emotions have nothing to do with the market. They have to do with the size of your bet. If you're overly emotional, your bet is too big. Maybe it's $1, maybe it's $1 million, whatever it is. There's some emotional quotient there where it's too big for your emotions and you perform like an idiot, like a clown. Your emotions take over the rational process. So you have to back away, wherever that is. It's different for everybody. You have to know where that emotional money management quotient is and then be below that.
And again, that's probably a hard skill to learn, but invaluable once you combine it with maybe adding trading stops and just discipline to your trades, right?
Yeah, well, you get beat up enough. I mean, I had some big losses in my career. People look at all my big wins. Well, let me tell you, there's been some big losses too. There's been some, really down periods in my career. We all have them. It's not unusual to me. Every trader has them. But you learn. That's a great learning experience. I mean, every loss is a learning experience. Nelson Mandela said that a little better than I said it. But he learned from his losses, so they weren't a loss, they were a win. And I look at that way when I've done something wrong in the market. What did I do wrong here? What did I learn here? So I learn a lot from my losing trades. So I eventually maybe I'll get smart because I still have losing trades.
Excellent, Larry. Well, I think that's a pretty good place to wrap up today's conversation. Is there anywhere you'd like to point to if any of our viewers would like to learn more about you?
Well, we do have a website, ireallytrade.com. I don't publish anything anymore. I do some stuff for stockcharts.com. I've written some books. The best place to get them usually is eBay. They're a little cheaper there than any other place. We do send out things occasionally, a market viewpoint, or I'm going to be on some place, or we'll let people know. So you sign up at ireallytrade.com. You can do that, but there's really nothing at this point to buy. I'm 80 years old. I'm looking for the off ramps. So I'll leave it at that and just wish everybody, as I always do, good luck and good trading.
Excellent, Larry. Thanks so much for your time today. Really appreciate you sharing your perspective with us.
It's always a joy to do it. Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.